Hey everyone, I want to welcome you to this special episode of the HX podcast. What we're going to do today, which we do occasionally, only a couple times a year, is we talk about a free idea that we're giving out to our audience. Today's idea is coming out of our investing publication, which is called HX Legacy. And let me just explain a little bit here. HX Legacy is the long-term investing strategy that most accurately mimics what I did in my hedge fund strategies, where I managed billions of dollars for multiple decades. And what we're looking to do are find ideas that we think have a minimum of 100% return, but at least a 3-to-1 risk reward. So to be honest, we're looking for things that have 100, 200, 300% return, but we're also saying we don't want things that are going to go out of business. The final piece, and this is really what HX research is about, is we want to find things that maybe you've never heard of. So, I don't know, maybe NVIDIA can go up threefold from here, but we're not going to be recommending NVIDIA anytime soon because everyone knows about NVIDIA. What we're going to do are find things where we can take advantage of the network that I have, again, having managed billions of dollars, having access to all these incredible investors, and we want to bring you those kinds of ideas. So for this video and what we're going to do on a lot of these videos is we've actually invited a reader to come join us, and I want to say hello. This is my friend Mark Becker. He's a great supporter, fellow Arizonan. How you doing, Mark?
I'm doing good, thank you.
Awesome. Well, I appreciate you taking the time. Mark, so the format today is I'm going to present the idea. We're going to talk a little bit about it. I know there's some of you watching this video who haven't read our free report, but if you're interested in it, you can go to our website, daily.hxresearch.net, and right at the top of the website, you're going to say it says free idea HX Legacy, and so you can read the report there. Mark's read the report, but what I'm going to do is I'm going to spend about 10 minutes going through the idea and kind of the big picture of it. And then what we'll do is we're going to open it up some questions, because this whole idea came about because Mark is one of my most engaged readers. He was hitting me up. He had this question, and I was like, oh, these are great questions. Let me figure out a way that we can maybe present the idea and then have go and go through your questions as well, because other readers might have these same questions. So, okay, Mark, here we go. We're going to kick it off. I'm going to actually share my screen here. The idea that we're going to be talking about and the company we want to present today is a company called Talon, T-A-L-E-N, Energy Corporation, okay? The ticker is TLNE. T is in Thomas, L is in Larry, N is in Nancy, E is in Edward. Excuse me, I can never get those Air Force call signs right, so that was a little messy. This company is a power generation company, okay? What they do is they own power plants. And I want to take a quick step back and talk a little bit about the utility and power generation area, because it's an area that I've made a ton of money through the years. It was one of the first areas I started looking at investing back in the late 90s. And what attracted me to the area was that there's incredible visibility when you're investing in these businesses. The power always needs to be on. The power demand doesn't change that much. We have household formation and economy and all that. The transmission networks, the power plants, these things take years and years to build and billions of dollars. And so what I always liked about it was when you go and look at the utility business, and just so you know, electric utilities, you can basically break them into three parts. Number one, you have your power generation, which is the power plant. It could be a nuclear plant, it could be a gas plant, it could be a coal plant. You have what's called your transmission, which is the wires that take the power from the power plant to the curb, so to speak, and then you have your distribution. These are the wires that actually go to your house, and that's what an integrated electric utility looks like. And so what I thought was always so cool was you could find times where, for whatever reason, and we're going to talk about this in a second, you could find an electric utility business that had been disrupted. It might have been weather, it might have been a fire, it might have been, some change in regulation, but then you could make a bet that that business would recover And because a lot of this was regulated and there was so much visibility, you could make very high confidence bets. And that's what Talon is. Okay. So this was brought to me. This idea was brought to me by a friend of mine. He was a utility analyst for 25 years, 20 plus years. I've known him since 1997. Well, the top ranked analyst out there. He actually most recently was working at, a $7 billion utility hedge fund that is as plugged in as anything on earth. And he left there a while back, and he said, you got to check out Talon Energy. And what Talon Energy is it's a company that owns power plants. The genesis of the company, and a quick backstory, is that there is a utility in Pennsylvania called PPL. PPL is the old Pennsylvania Power and Light. And PPL was one of those integrated utilities. But back here, and here's a slide from a firm called Philosophy Capital. I pulled this off. It's available on the internet. It was actually in a presentation by someone at an Iris Sohn conference. You can go look it up. But Talon was formed in 2015 when the assets, PPL took their power generation assets, which consisted of a big nuclear power plant and a bunch of little plants, and they combined it with a private equity company called Riverstone, who had bought up a bunch of power assets, okay? So Riverstone's idea was they were going to buy these power generation assets, put a whole bunch of debt on it, take it public, and then they were going to make money because the company would generate profits to cover the debt and go, do profitability above and beyond the debt load and to take advantage of the equity and all that. Well, they ran into some problems. The issue is that the way the power markets have changed through time, it used to be we had only integrated utilities, and then 100% of the equation was regulated, okay? Power costs this much, you paid this much for distribution, this much for transmission, this much for power generation. But through the years, to inject competition in, they pulled the generation out and made it so that generators could sell to anyone on the grid. So these PPL assets could sell to the now the Talon assets, could sell to the PPL distribution network, they could sell to Constellation Energy, they could sell to PSE&G, all these utilities around there. So what happened with the Talon assets, again, back in 2015, PPL took their generation assets, Riverstone took theirs. They put them in a company with a bunch of debt. What then happened, though, is that as we moved through the next 5-6 years, we went through a bear market in power generation prices. There were a bunch of reasons. There had been a lot of development in the previous years. Natural gas got really cheap. Demand just didn't really grow. And when they did this, they put hedges, and we're going through this part quite quickly because I'm going to get to what the company is today. They put in hedges where they were trying to lock in power prices and lock in their costs. But when the power markets collapsed, their hedges went upside down. Long story short, going into 2020, 2021, especially when COVID happened and we saw a big drop in demand, the company went bankrupt. They couldn't pay their debt. They couldn't make their interest payments. So the company went through a Chapter 11 reorganization. Now, this is important because what they did is they said, we have all this debt. And I'm using this in very simple terms. I know a lot of you are a lot more sophisticated, but they said, we have all this debt. We're not going to be able to pay it. Let's write the debt down, let's refinance it at a lower level, and let's issue equity to the new holders. Okay, that's a Chapter 11 reorganization. Now, one interesting aspect of this, and this was finished in May of last year, is that the stock was listed back in the day. Again, PPL merged with Riverstone. It was a private company. They took it public. It was public for 3 or 4 years. It went out of business. But then the new stock, the newly recapitalized company, relisted in May. It's listed on the over-the-counter market, or what are called the pink sheets, okay? What this is it's a listed stock that you can trade. TLNE, you can go in, you can do it on Schwab, you can do it on Fidelity, any of that. But what happens is, because the company was bankrupt, it doesn't meet certain characteristics historically about certain levels of earnings, certain levels of cash flow, et cetera, because it went bankrupt. So of course it can't. But that doesn't mean there's anything wrong with the stock. But because it's on the pink sheets, Institutions can't buy it. There are a lot of institutions, indexes, for instance, mutual funds. A lot of utilities are owned by mutual funds. They have to have a dividend in order to buy something. But a lot of them have restrictions that they have to be able to buy it on the NASDAQ, or it has to be on a listed exchange, the NASDAQ or New York Stock Exchange. Talon, TLNE, wasn't listed on any of those, and it still isn't. It's listed in the pink sheets. This is what created the opportunity in this stock. Or one of the opportunities, because what happened is there was a huge group of buyers, basically almost all institutional money, that couldn't buy the stock. That also means there were barely any analysts that would cover the stock because the volume isn't there. So that means the stock was also uncovered. That's where we come involved. And this great presentation here, again, from Philosophy Capital, back from May of last year. This is right when the company came out, kind of outlines what the company is. But first, I want to point out there's this opportunity because it was in the pink sheets and it still is. So what is Talon? Well, when Talon came out, they basically had, for all intents and purposes, 3 assets. The first asset is, and you can see it here, they own and operate 12.4 gigawatts of generation assets, nuclear, gas, and coal. Okay, gigawatts, it just means a lot of power. I forget how many homes it can power and all that. In particular, they owned one asset that makes up about 50-60% of their power generation assets, which is a nuclear power plant called the Susquehanna Nuclear Plant. It was built between 1976 and 1983 at a cost of about $8 billion. And we're going to talk about that cost in a little bit. And this plant is 90% owned by them and 10% owned by another utility, okay? This is the 6th largest nuclear power plant in all of the United States. So asset number 1, they generate power, okay? Most of it's from this nuke. The rest of it is from a bunch of other assets powered by natural gas, coal, et cetera. At the time they came out, this is a year ago, a little bit less than a year ago, they also had 2 other assets. They had an asset which was a data center. So think of what Amazon does, Amazon Web Services. What Talon had done is they said, well, we've got this nuclear power plant that has all this power. We're going to build a data center business right next to it because we have access to cheap power. It'll be a competitive advantage. And they put about $300 million into a data center business called Cumulus. And then the final asset they had was part of a lawsuit and a litigation that they were looking to that they were probably going to make $100 million or so. So you can see here, I'm just going to this Philosophy Capital slide. You can see here they own and operate 12.4 gigawatts. It's the Susquehanna nuclear plant, 50% nuclear, 35% natural gas. The 60-70% is the percentage of earnings. Miscellaneous, they have the 300 invested in the digital infrastructure assets through Cumulus Digital. And they have a couple of other assets, okay? You can also see here, I'm just showing you a slide, emergence from bankruptcy. You can see what happened with the company and all that. So what's happened here recently, and I'm going to go to another slide here. This is actually a recent presentation by the company. This is available online. This was with their most recent quarter. Let's look at this slide. Remember, they had 3 assets. They came out of bankruptcy. They redid the debt. They redid the equity. They had 3 assets: power generation, the data center business, and the lawsuit. Here you can see 2023, they had great performance. What they've actually done is those other 2 assets, they've monetized them. We originally recommended this stock with 60 something, I forget, back in February for our paid subscribers. And since then, they went out and settled the Talon Montana litigation with PPL. That was $115 million gross and $104 million net, or about $2 a share. And then they did a deal on the data center where they sold the data centers to Amazon Web Services. And I'm just going to go to this for a second because this was a huge driver. The stock flew from 60 to 80. And I'm going to go through here and just show you the transaction details here. So you can see here, they took this business, they had put about 300 million in, they sold it for 650 million, okay? And that means they'll get gross proceeds of about 361 after they pay off some debt, some other stuff. So let's cut through the noise. You had a company out of bankruptcy, they own a bunch of power generation, data center, a litigation. They now have settled the litigation. They've sold the data center. We'll come back to that. Okay. Now you own this power generation asset. Okay. And this is what is in the generation portfolio. Just so we can look at it right here. Here is Susquehanna in Pennsylvania, 90% ownership, 2.2 megawatts, went online 1983, 1985. And here's a bunch of the other stuff that they own, the natural gas, the coal, etc. So what got us so excited, and I want to show you here too, this is what the company's balance sheet looks like today, okay? So when we talk about balance sheets, you look at the cash that a company has, the debt, and then you look at something called net debt. That's basically taking the debt minus the cash. This company has a net debt of 1.7 billion. So what got us excited about this company in the first place was we said, look, these power generation assets, these nuclear assets, they're some of the rarest assets on Earth. There are only about 220 of these assets in existence. Okay, this is the sixth largest in North America. And you have an opportunity here. This is a subscale company, okay, that owns this big asset. And our belief was this. The stock was undervalued because a lot of people couldn't do the work and understand the math. They would go through and do these sales of these assets and clean up the story. And then our third point was we think eventually it gets bought by some of these other competitors. There are two big nuclear competitors, Constellation Energy, which is the old Baltimore Gas and Electric, which is the biggest nuke operator in the country, and another company called Vistra. But what's interesting, and Mark, we haven't talked about this, there's a fourth catalyst that's happening, okay, which I had a sense was going to happen, but has really exploded. And what's happened now is we're seeing data demand go through the roof. And so what's interesting about the power generation business is that, power generation, the price of power is supply and demand, right? The supply is how many nukes, natural gas, coal-fired plants, and new renewable generation, solar and wind we can have out there. But I'm going to tell you something about the supply. The supply growth is very limited. These things cost billions of dollars to build. They take years to build. And then you're running into one of two things when you're going out to do new power generation projects. Either A, you're running into NIMBY, not in my backyard. No one wants a new facility, God forbid a nuke, but no one even wants wind power or any of that. Or B, you're running into environmental concerns. What's happened is there's been a huge pushback against natural gas plants. I think it's ridiculous, the whole thing. I think it's just all made up, but it doesn't matter. What's happening is that the actual additions of new power are de minimis. There's almost nothing out there. And so what we're now seeing, though, is you're seeing three drivers emerge for power generation demand. Two of them have been around and are kind of growing slowly, but the third has basically exploded in the last 12 months. The first one is electric vehicles. The more electric vehicles we put out there, the more power we're going to need. They still have to get power from somewhere. That curve has been building very nicely. The second is actually reindustrialization. We've been doing a lot of reshoring in this country. Industrial demand has been going up. But the third is AI. And I hesitate here because everyone talks about fucking AI. Okay, AI this, AI that, and I get it. I think there's a lot of hype. But there's a lot of reality too. The compute power and the energy that's needed for AI is very real. And right now, and I'll tell you, I was talking this morning to my buddy who gave me this idea, and he recently was consulting for one of the biggest utilities out there, working with the CEO, et cetera, has great access to information. He told me a story. He said that one of the major AI competitors went to one of the largest nuclear power generators in the country and said, we want to buy 50% of your power generation for the next 30 years. They said, we just want it all. Well, not all, but 50% of it. And the company basically said, we can't do it. We don't have it. We wouldn't be able to serve the other customers out there. But right now, the data center business is in this land grab. I think that when you're looking at Microsoft, you're looking at Amazon, you're looking at Meta, you're looking at, Apple at some point. But, all these people that are in that business, they're saying to themselves, if I'm not first, if I don't get scale in AI, I'm going to be last. So what we're seeing here is power generation has demand has grown a lot. Here you can see in the slide, this is from their presentation, grid planners have nearly doubled their five-year load growth forecast. A lot of it is also demanding clean, reliable, zero carbon energy. Because here's the thing, is when they're looking at the power that they need, they don't want you to go out and build coal power plants to power AI. That just doesn't look very good. They want the cleanest energy out there. And the cleanest energy out there that's truly dependable and is always on, because that's the other thing. Renewables, solar and wind, they can be powerful, but they go off. The sun goes down, the wind stops. Nukes are on all the time. Guess what else is on all the time? The internet, data centers, AI. So they're looking for, this reliable power. And you can see here, this is another from their presentation. Look at the data center and AI driving electricity demand growth. You can see these big circles. There's also a great article, I'm going to put it here, it was behind a paywall for the Washington Post. Amid explosive demand, America is running out of power. There were some great things in here. They talk about how in Georgia, they doubled the amount of demand they thought they were going to see. In Oregon, Portland Gas and Electric, is seeing a tripling in demand. So the base point here, and I keep on taking a step back, is we have this company, Talon, went bankrupt, came out relisted, cleaned up the balance sheet, had these 3 assets, sold off 2 of the assets. Now they're a power generation company powered by this big nuke. And the exciting part, it is undervalued, but the exciting part is that there is very little supply growth in power generation and a lot of demand growth, and we think that the nuke can earn a lot more. Okay, so those are the basics of it here. So what I'm going to do here, I'm going to go to one more sheet here, and then I'm going to open it up to Mark because I wanted to do a little bit of an introduction. All this is great. This is all like, okay, so I understand they own this nuke. No one knows about the company, but what's it worth? What's it really going to trade at? Okay, and the stock today, I'm just looking at another chart here. The stock today is about $90. Okay, we recommended it at 60 something. So I'm going to show you here. Here's a quick sheet. And again, I actually think Mark's pretty sophisticated when it comes to finance. He knows a lot about enterprise value and debt and all that. But I'm going to do this. I'm going to pull this sheet up for everyone else. What I'm going to pull up now is actually the enterprise value valuation of the company, okay? And what enterprise value means is this looks at the value of the company as a whole. So companies have stocks. In the case of Talon, they've got 58 million shares, okay? And then that stock has a price. We're going to update this real time, okay? Because I'm looking at my screen here. Stock literally closed at $90.01. Okay, so the market cap of Talon today is $5.2 billion. Now, that's not what the company's worth because the company also has debt. Those people have a call on the asset. So for this enterprise value analysis, what you want to do is you want to add the equity plus the debt. Remember, we said they had $1.7 billion of net debt. So that means that the enterprise value currently is $6.959 billion. Let's call it $7 billion is the enterprise value. So what we can then do is look at...
Hey, Enrique.
Yeah, shoot, Mark.
Can I ask a quick question?
Yeah.
When is that maturity of that debt? How much more time do they have?
It's a great question. And give me a second here because we're going to go. I came prepared, Mark, because I knew you were going to have great questions. So I'm going to go here and actually go to the company presentation again. Debt maturity. Okay. So they've got $700 million that's due in so actually I take this back. They have a revolving credit facility availability of $700 million. So that expires in 3 years, but that's money they haven't taken down. They just have the availability. The 2.066 is a term loan, which means it's with banks who are more than willing to work with them and all that. And that doesn't expire until 2030. So we have 16 years before that comes in. And then there's unsecured municipal bonds of 130 in 2037. So they got loads and loads of time before they need to pay back any of it. Okay. But one of the things is that was a really big concern previously when the company went bankrupt, but the company's profitable, so the company's cash flow positive, actually nicely cash flow positive. So the debt load, I've got no concerns about it. You saw maybe on the other On the other slide, it said the 1.7 billion. So let's go down this enterprise value. Now we talk about the EBITDA. Okay. Now I'm not going to get into an EBITDA rabbit hole here. But just so for everyone out there, EBITDA, and a lot of people rail against it, it's basically a way of measuring your core profitability of your operating business before you layer in things like taxes and like interest and debt. It's like, what does the business actually make? Now, it's interesting here because with Talon, and I haven't really put this in here, they've got net operating losses, I think, of 1.5 billion. So this company's not going to pay taxes for a number of years. But what we have here is the company's EBITDA, their normalized EBITDA should be about $750 million, okay? Which means when we then take this 7 billion enterprise value, divide by 750, we get 9.3 times. Now, I'm going to go back to the presentation again because the company has gone out and actually given guidance on their EBITDA, and they've been beating this guidance. They recently updated the guidance. So we're using 750 in our number, but here's the company's most recent guidance, okay? They're actually saying that their range is going to be 640 to 840, okay? So 640 to 840, you divide it, you get to 750. Okay, that's where we're getting this 750 number. But I want to tell you something here, and I think there's another slide in here. When they give this guidance, you have to understand they have incredible visibility on this because when you sell power, for the most part, you don't wait until that day to sell it. You sell it ahead of time. So here, look at this slide. Here's their contracting for nuclear fuel. Okay, they are 100% contracted in 24, 25, 80 and 26, 87, 27, 97 and 28. So they got all the nuke capacity that they all the uranium they need. And I was looking for another slide, but they're basically 90% sold through on the power. Meaning that they know the prices they're going to get. So let's go back to that enterprise value. And then I'm going to finish here in a second, Mark, and I'm going to open it up to questions for you. But again, I know there's some people who haven't read this, want to get this out here. So 9.3 times EV to EBITDA. Okay, this is the value, the enterprise value divided by the profitability. What do we think it should trade at? Well, here's a couple things to think about. Let's go to the bottom of this slide. The plant, Susquehanna, cost $8 billion and was finished in 1983. Okay, let's think of replacement value. Well, if I just take 8 billion and subtract out the debt and divide by the shares outstanding, I get $108 a share. That's 20% up from here. But let me tell you something. That's 8 billion in 1970s dollars. $1983. $1 in 1983 is actually $2.5 now. That implies that instead of costing 8 billion, it would cost 20 billion to build the plant. I don't know what it would cost to build a new Susquehanna. I'm just going to say it's higher than the share price. You could go out and say that the replacement value of this nuke, one of only 200 some nukes in the entire planet, this stock trades cheaper than the replacement value of what it would cost to build a new one. That's point number one. Point number two, there was another company that was sold, ENGH. I want to say maybe it's called Energen. I'm going to get that wrong. I apologize. But it was sold recently. It had a big nuke asset, sold for 11 times. The asset wasn't as good. It wasn't as new. It didn't have, wasn't as well positioned. If we put 11 times on this, so because I do think this company will be bought. I had thought it was going to be bought by Constellation or Vistra. I got to tell you, I wouldn't be surprised to see Amazon come in and buy this company or Microsoft come in and buy one of these three nuke companies. At 11 times, we get $112 a share, okay? So let's go to our final piece here, is Constellation. This is the leader. It's the blue chip. It's the Microsoft of nukes. There's only three nuke companies that are pure plays. Again, Constellation, Vistra, Constellation ticker CEG, Vistra ticker VST, and Talon, which no one knows about. So it blows my mind why this stock is such an incredible opportunity. And if we put Constellation trades at 15 times EV to EBITDA. If I put 12 and a half times on Talon, we're looking at 130 a share. That's 50% upside. Let's go and let's have some fun. Let's put 15 times. We're looking at $164 a share. That's almost a double. So my point is, and I'm going to have one thing that I'm going to hold in my pocket here at the end that I want to show you, Mark, which is also what I was playing with today, is the even though the stock is run, it came out at $40 a share. At $40 a share, it was a ridiculous valuation. It's just no one knew what was going on. There were all these pieces that had to move. All those pieces have moved. The debt's taken care of. The company's throwing off $300 million a year of free cash flow. They're actually buying back stock. They've got contracts in place. They just did this Amazon deal. And one thing, we're going to come back to this. Amazon, when they bought the data center business, contracted to buy power at $70 a megawatt hour. Right now in PJM, which is the regional area, power sells for $45. So they sold it at a $25 premium and Amazon's locked in. So if we just play out what's out there right now and we play to a multiple like its peers or where it could be bought, and by the way, Constellation has a plant that's identical to the Susquehanna plant around 150 miles away. That's really important because it means that Constellation, which trades at 15 times, could pay 20 times EBITDA. Let's have some fun. I haven't done this yet. 20 times EBITDA is 154, but the reason why Constellation can pay that is because they have cost cuts because they run the same kind of plant. So my argument, what did I just do there? Here. Okay, there we go. My argument is that, I think we've got 20 to 50% upside to the stock just to start before we really see a re-rating just from playing this out and getting this out there. And the last thing, catalyst. I'll leave this and then I'm going to open it up to you, Mark. Again, I apologize. This is a soliloquy, but I wanted to get there for people who aren't familiar with the story. What's going to happen? Number one, at some point, this company is going to list the stock on the public exchanges. Now they can do that. When they do that, there's a huge swath of investors, institutions, ETFs, et cetera, that are going to come in and buy the stock. They want to buy it right now, but they can't. They can do other things. They can put in a dividend. They could probably put in a dividend within the next 6 months. Now all the utility funds can buy it. So as you see this demand come in from all these people that probably know it, but can't buy it, I think that alone is a catalyst. And I think as people get out there, and I'll give you this one last point. What's happening in power, we're facing a power crisis in this country that you haven't heard about yet, but you are going to hear about a ton as reshoring, as EV, as AI picks up and accelerates, and as all these fucking ridiculous rules keep us from actually building power prices are going to go through the roof. And what happens is power prices don't go up linearly, okay? You're not at $50 and all of a sudden we go to 55 and everyone says, oh, well, now we have enough power. There's no extra power. What happens is power prices go from 50 to 200. Okay. And they go to 200 because at 200, all of a sudden the marginal user, the factory down the road says, fuck it. I can't make money at 200. I'm out. Okay. But what that means, you know what happens with that 50 to 200? They make all of that money. So I'm going to pause there because there's a couple other points I want to make, but Mark, let's go in because you had some great questions for me and I want to attack those.
My first question for another comp is Vistra. What is that trading as a multiple of EBITDA?
Vistra right now trades at 8 times EV to EBITDA. So this asset is trading at a premium to Vistra, but I think Vistra is ridiculously cheap. And I would think this is going to trade closer to a private market value, because one thing to consider, the market cap here is 5 billion. Let's say it goes to 10 billion, like, the stock doubles. Constellation's market cap, because all these stocks have run, Constellation is a $60 billion company and Vistra is a $25 billion company. They could bite this up in a moment. And that's not even getting into my crazy Amazon thesis where they could buy this in a, for like a 3 days of earnings or something like that.
Vistra's been on a tear. It's been going up a lot lately too.
Both all these stocks, yeah. and it's funny you mentioned this. I wrote about this. So when we recommended this stock, we recommended it at 60. And let's see here. I want to actually pull up. I don't have my Bloomberg up here, TLN stock chart, but I'm going to pull up on Yahoo Finance.
Because you recommended Vistra when you were at your
at,
old
at
company, I
at
remember.
Empire, we had recommended Vistra as well. We did a whole report on the nukes. So let me go. I'm going to switch the screen here, and I apologize. I don't have my Bloomberg up and running. I should have had that here.
And
This
the other thing that would be interesting to know, we might not be able to pull it up quickly here, would be how much of Vistra's power is pre-committed versus Talon's. Like Talon's pre-committed, so you can't. It's not. It's good in one hand because you have good visibility to their earnings, but if the cost of power goes way
so
up,
that's
they're already sort of
that's
locked
that's
in.
for this year. In the out years, there's more flexibility. But here, I just want to show the chart here. We recommended Talon right around here in the high 60s. You can
Yep.
see here it's gone ballistic. You can take a look at the chart of Vistra. It's going to be the same thing. Let's go to a 1 year chart. All these things have just gone. Now, I'm going to tell you, Vistra is actually up more than Talon, right? Vistra has gone from 43 to 71. It's up 80%. Talon's up only 30% in that same time. Constellation is up. Let's take a look. I don't actually know this number we're about to see here. Constellation is up 135 to 187. It's up a little bit more. So Talon's actually lagged the rally in those stocks. The reason those stocks went up, you see this chart here, Constellation, you know what date this is? Right here, where it goes ballistic? That's when the Talon deal was announced. So let's go into power prices a little bit, because you bring up a thing about Talon. So I built a model, and that model goes through, and I'm going to pull up the enterprise value here again, because I think this will be really instructive. So right now they're at $45 a megawatt hour, okay? And every dollar that is above that, they make an extra $15 million, okay? So if we think we're going to a world in 3 or 4 years where that Amazon price is right, okay, that's $70. So we're going to do equals 70 minus 45, $25 equals times, let's do this, equals
15
that
million. Yep.
times 15 is 375 equals that plus 750, which is my current base, 1.125 million. Let's go have some fun. Let's go put 1125 in there, and then let's go put in 15 times, and you're looking at a $270 stock price, okay? Now, this is actually very real. This is very believable. PJM prices have been there before. We've seen these spikes. But what I'm going to tell you, this is like, you want to play clean power? This is the only way to do it. There's no other way to do it. There's 3 of these stocks. And, I think that you could, as this story gets more well-known, I don't want to say it'll go meme stock, but I could see these things going meme stock. But screw that. The stock could double before we even have to think about any of that to get there. But there's a lot of upside to these numbers.
One other question I had is, do they have more capacity within their current plants to just expand and add more power capacity? I know
Yeah,
it takes a long time to get the permits and
the
environmental and
unfortunate the
regulation,
unfortunate answer
but
is
because
no.
they're already existing, I'm wondering if,
Yeah, I don't think it's going to be possible.
okay,
I mean, I think that what most likely happens, well, look, I think that there's a business called the IPP business, independent power producers. When deregulation happened in the 90s, there were all these independent power producers. You know who one of the biggest beneficiaries of IPP business was? Enron. Some of the biggest money Enron made in the late 90s. And we've seen something like this happen before. In the late 90s, we deregulated, and we saw the first internet, the first wave of the internet, and we saw this rush to build fiber optics. It's very similar to what's happening right now with AI and NVIDIA. Just replace NVIDIA with Cisco and Corning. I don't remember Corning, ticker GLW, for selling fiber optics. But power prices at the same time also spiked. So all these IPP companies, Calpine, NRG, all of them came public. And then what happened is all this money went in, built all this capacity, and then the bottom just fell out and they all went bankrupt. Okay, Calpine sold for like 4 times, 20% free cash flow yield. Calpine sold at 4 or 5 years ago. But I think we are in front of a massive power squeeze. And what's so cool about this is that I know what supply is. I'm not going to wake up. So NVIDIA is a perfect example. Capacity for AI chips is going up and going up a lot. Everyone's going to build them. AMD's going to build them. NVIDIA's going to build them. Intel's going to, anyone who can build them. Amazon's going to figure out to build them. They don't need, they need technology, but you don't need permits. It's not freaking nuclear. Like you can figure out how to build more capacity. Capacity here is not going to grow. So the downside to Vistra, or the downside to the upside is I don't think they're going to grow capacity. The upside to it is that I think that EBITDA could be much, much higher here than here. And one other thing, and I was waiting for you to ask this question, but I'm going to shoot ahead. You asked me the other day, what is their power cost? Their power cost $22 a megawatt hour out of Susquehanna. Okay, it's a top quartile power plant. And actually, let's go back because I like using these slides.
And then
go ahead.
And then related to there also in your write-up, you mentioned that there's some legislation that got passed that has
it's exactly what I was going to talk
minimum.
about. Yep, exactly. So this idea is fucking crazy. Like the fact that things like this exist in the market. But I talk about like why I do this and why people should subscribe to whatchamacallit, to HX. Most people aren't going to find these kinds of ideas. These ideas are deep in the weeds. I got a guy who is at the highest level of the utility business. He's basically, he fished this out for me. So in answer to your question, in the totally inappropriately named Inflation Reduction Act, okay, there were actually some tax credits. They were called the PTC tax credits. And these tax credits basically said the following. They said that there was going to be a $10 floor to, there's going to be a $15 tax credit if power prices fell below a certain amount, and would put a floor on prices. Okay, that's a lot of stuff. What does it mean? If you own a nuke, you will earn no less than $44 a megawatt hour, okay, for the next 10 years. So that means no matter what happens, power could go to $2. They will earn $44. Now, the taxpayer is going to pay for that. I'm not here to justify that one way or the other, but their power costs 22. They're making 44. So when we talk about risk reward here, I say, what could go wrong? I mean, not the economy. There's not enough power out there. Regulation? No, the regulation is set, not the balance sheet. I mean, I suppose there could be problems at the power plant. The last power plant we had a problem with in North America was literally 3 Mile Island, like, 40 years ago, whatever it is, 1979. So this is locked in. Not only do I think we have visibility on the upside, but we have visibility on the downside that there is a core EBITDA. And that core EBITDA, if you go down to that 44 floor, it's about $600 million, $700 million. So right now, I would argue they're actually earning not too far from the base EBITDA of what the company should be doing. So, it's this risk reward. We talk about 3 to 1. Look, when you buy a stock, remember that chart we did, it goes like this, then it goes like this. The stock could pull back 10, 20% in a day, in a week. When stocks go up 30% in 2 weeks, that's what can happen. But it's either going to do that and consolidate or consolidate around here. I really don't see, it's hard for me to get to the downside. So what we're recommending to folks, we started with a 7.5%. It's overweighting. Normally we're at about a 5. 7.5% HX legacy. When it went up 30%, we sold 2.5% just to lock some in because that's what we do. When we did the original recommendation on March 6th or 7th for the free readers for HX Daily, we said 3.5%. What I'm going to tell you is I'm sitting on another 1.5%, 2.5% that I'm kind of waiting for the stock to consolidate, and either it's going to trade off or it's going to trade sideways for the next couple, for the next month, and we'll buy it again. But I think we're going to see. You're hearing it here first. AI power crisis. This is coming. You're going to see it on CNBC. You're going to see it on the cover of Barron's. You're going to see it everywhere. And when this wave comes, these stocks, they got a lot more upside from here.
And I think you mentioned it briefly, but maybe it requires a little more attention or detail. But that tax loss carry forward of almost
Yeah.
a couple $1 billion, that's a huge asset. I mean,
Well, and so
that
we're
wipes
not.
out.
Yeah, we're not talking about it so much, but one of the things that's going to happen, the company has a $300 million buyback in place. They've been buying back stock. The company, according to their own guidance, and I'm just going to go here to the slide without sharing it so I don't have to pan between screens again. The company, according to their own guidance, is going to do this year 185 to 335 million of free cash flow. They're going to do 300 million of free cash flow, in my opinion. That cash flow is even better because of the NOL. That NOL, remember, if they go and sell to Constellation or Vistra, which are EPS positive, that NOL gets monetized. So, sometimes, Mark, when you look at these situations, I try to not get caught up in false precision. I think that, and you read this in my reports, right, is I could go out, I could do this like 10 pages of enterprise value scenario analysis, and they do this and that. And I could have done that when we initiated on the stock in February. Instead, I said this. I go, look, they're going to sell the data centers at a good price. They're going to get the litigation done. Think about the big picture. The big picture here is you got a great balance sheet. You got a profitable business. It's locked in. The downside has a massive floor. It's one of the most valuable assets on earth. It's sitting on one of the biggest trends. You've got all these ways to win, NOL, et cetera. And like I said, what's going to blow people's mind, and I actually think I'm going to say there's a 50% chance this happens. I could see Amazon going out and trying to buy Constellation. Okay, Amazon can't buy a lot of stuff right now, right? Because they're too big.
Constellation or Talon?
Constellation. Because if I'm Amazon, so I see Constellation buying Talon because they just have they can pay 20 times EBITDA because they have the sister plant. Okay, I see Constellation buying Talon, and then I could see Amazon going in and buying Constellation. Now that's going to drive I don't even want to get into the regulatory of that, but Amazon doesn't own any power assets. What's to stop Amazon from buying Constellation? It's got to go through regulatory processes, but this is how valuable these assets are. And I think that, I'm as excited as I have been. I was excited about this idea because it's one of these, I love utilities. I get one of these every couple years, occasionally I'll have two in a year. Sometimes I'll go 3 years without one of them. These are just great risk rewards. I love the pink sheet, et cetera. And then this just went smack dab right into the heart of an emerging theme that I think is going to be all over, and there's just no way to play it. So I think it's right here at $90. I think it's a huge buy.
I like it too. Good find. I love that it's under researched and it's not quite on the major exchanges yet, which kind of explains why it's undervalued.
We talk about, and let's get back to kind of the idea of HX. Regular investors have a disadvantage. There's no research on this. There's no coverage. They don't know my friend who covered utilities for 20, 30 years. They don't have 25 years of experience. There's no way to find out about these ideas except through someone like us. But regular investors have an advantage in this one. They can go out and buy an OTC pink sheet all day long. Like there's nothing stopping them versus the institutions. So this is, look, in HX Legacy, we're going to have at any given time 20 to 30 ideas once we eventually get ramped up. Not all of them are going to be completely off the radar screen like this, but this is our value proposition. I'm not here. I have a lot of opinions about NVIDIA and what you should do with NVIDIA stock. You don't need me, though. I think they're very educated opinions. I got their high probability, but that's not what we're here for. We're here to give ideas like Talon that you'll never find anywhere else. This is my life's work. This is the culmination of it with HX Research. So I want to thank everyone. First off, Mark, I want to thank you. Actually, do you have any last questions, Mark, before we call it a day on this one?
No, I think we're good. Much appreciated.
Okay, great. So I want to thank everyone for joining us on the HX podcast here. Our free idea at any given time, we'll probably only have one of these outstanding on the long-term ideas. The trades will usually have one outstanding because they last, 30 to 90 days. But we appreciate your support. You can check us out, the free daily email, daily.hxresearch.net. On Twitter, HX_research. I'm Enrique Abeda, also on Twitter. And as always, we appreciate your support, and everyone have a great week.